Hi folks, this is Professor B, Intermediate Accounting 1, Business 137, Chapter 5, Problem 5-32. In this problem, they give us information for Tulip Corporation and ask us to create a partial cash flow statement from operations using the indirect method. I wanted to go through this problem because we haven't had a chance to discuss this, and it is an important statement in the total uh, collection of financial statements. Obviously, we have the balance sheet and the income statement that you are familiar with, and you're most likely familiar with the statement of retained earnings as well. But we haven't talked too much about the statement of cash flows, so I kind of want to discuss that with you today, and it'll help you with problem 5-40 in the homework this time around. So let's take a look at this. They've given us information from the comparative financial statements of Tulip Corporation. They've given us some sort of an income statement which has some sales revenue and some cost of goods sold. And they've given us partial balance sheet accounts as well, accounts receivables, and the beginning of the year, for example, ARs were 22, the end of the year were 15,000. So they decreased, right? Accounts receivables decreased, and they want us to use the indirect method to provide us with cash provided by or used in operating activities for the year. So I kind of wanted to take some time explain this to you because it will help you with other problems as well. Generally speaking, a statement of cash flows explains the changes during the period in cash and cash equivalents, right? So in case you don't recall a balance sheet, it usually starts off with the most liquid asset known as cash and cash equivalents. And so what this statement does is it attempts to explain how the big cash at the beginning of the year turned into the cash at the end of the year, because ultimately if a business owner loses focus of cash, they could be in deep trouble. So this statement helps us figure out what that difference is, why the cash changed from the beginning to the end of the year. What are cash equivalents? They're basically highly liquid investments that can be easily turned into cash without a lot of work, right? So maybe like a certificate of deposit from a bank can easily be turned into cash, albeit with some penalties, but whatnot. The great thing about statement of cash flows is that it has the various activities a company has undertaken throughout the year summarized on one page. The cash flow statement includes information on operating, investing, and financing activities. These are the basic activities all businesses engage into to generate revenues. And this statement is able to give you all of the information that you needed for a particular company, all summarized in one statement, as in one statement, as in a statement of cash flows, right? So it's really kind of important for business owners to see at one glance what the entire business went through the entire year and how the cash changed. These three categories I alluded to on the previous slide need to be discussed a bit more. You see, all companies can be divided through these activities. Operating activities are routine in nature. These are transactions and events that enter into the determination of net income, right? We have a statement of income where we end up with the net results of operations, right? Operations as in operating activities. However, there are other things that a company does that can also be looked at carefully under investing activities. These are activities that either are a purchase or sale of a land, building, equipment, or other long term assets. And these assets are generally not held for resale, right? This is a merchandising business, for example. And financing activities are simply activities done to finance whatever it is that the company is trying to do. These include transactions and events whereby resources are generally obtained from and then repaid to eventually to the owners or the creditors. So let's start doing that with this company, the Tulip Corporation. Let's see if we can work on their operating activities. In the indirect method, we normally start with the net income for the company, and then we try to back out of that to determine the cash that was produced through the operations of the company, right? I mean, think about this. If you have net income, positive net income, don't you expect to have some cash from that net income that you should theoretically be able to add to the beginning balance of the year to arrive at the cash balance at the end of the year, right? Just logically speaking. And normally that's what we need to do with the indirect method. And in case you're wondering why we're going through this and not the direct method, it's because 96% of the companies in America follow the indirect method. And so we're going to focus primarily on that. And it's very similar to the direct method. The only thing really that changes is this first section here, the operating activities section. Because on the indirect method, we typically start with net income and try to infer from it the changes in cash that took place. There are some problems with this method though, namely an issue with depreciation. You see, for a typical business or even a small business, if you have net income, then you would expect to have that cash available to you. So for example, in this small company, if their sales revenue for the year were 1,000, just as an example, and their gross profit were 700, let's say, then they would take out expenses from that, and you would arrive at $300 in expenses, and then taking that away from gross profit, you would end up with net income of $400. Except the problem with this situation is that this depreciation item is not really a cash item. If you recall the journal entry we make to record depreciation expense, it's typically debit depreciation expense, credit accumulated depreciation, a contra account to an asset called equipment or whatever fixed asset that it's attached to. So we never really shelled out cash for this depreciation expense, yet it was part of our income statement. In other words, we are subtracting something that had nothing to do with cash, yet we're trying to determine the cash impact from net income. So what we need to do with things like this, with all non-cash items, such as depreciation or amortization of an intangible, for example, is we need to omit its impact on net income. So if previously you deducted $100 to arrive at net income, and you're starting with net income, you need to kind of add that expense back in that you initially deducted, right? So if you take out the depreciation from there, that net income, and I see the arrows off here, the income would change from 400 to 500, right? Because it's as if that depreciation expense, which was a non-cash item, never existed. And if that's the case, net income really should be 500, or at least that's a cash we should have if all things were being equal and most in cash, or if not all in cash, right? So typically with non-cash expenditures that were previously deducted to arrive at net income, and since we are starting with net income, the first thing we do is we bring back that expense that was previously deducted by adding it back in. Luckily, they give us the depreciation expense for the year in the textbook, and it's $50,000. And now that I know that I need to add back depreciation expense, I'm just going to use this column to share with you guys the logic behind what we need to do. We need to add that 50,000 here. I completely forgot. We should have started off with net income. If you had $75,000 worth of net income, as is given here to us, that should be the money that we have, just theoretically speaking. And now to circle back on depreciation expense, if this was an item that should not have been deducted, in case you wanted to arrive at the cash impact from net income, you'd have to add that back up. Same thing with amortization expense. They tell us the amortization of intangibles for the year was 20,000. So what probably happened was they went minus 20,000 for amortization expense. And then since we are starting from net income, we need to free net income from its impact. Okay. So that's the logic behind starting off with those two items. Then actually it gets rather simpler because we're only going to be working on the operating side of things. However, if we were looking at the entire statement of cash flows, I would just look at the information that they give us. Um, they tell us that cost of goods sold and sales revenue were such and such, and we don't really care because we already have net income. So I can ignore those items. Depreciation and amortization we took care of already. Interest expense on short-term debt for the year. So this was something that was previously deducted on the on the income statement, but most likely it was a cash payment, right? It was the payment we made for short-term debt for the year. So we don't need to worry about that. It has an impact on cash. So we can pretty much ignore that. And since it was properly deducted from net income, and since we started with net income, we can ignore this pretty much. And dividend declared and paid during the year are something that would have normally gone in the financing section. If you recall, we had said that anytime you have situation where you're obtaining financing or repaying it back to either the owners or creditors, in this case the owners being shareholders, and you're giving them dividends back, it's really a financing activity. So we would need to take care of this dividend declared and paid. Paid means cash. So we would have needed to take care of this on the statement of cash flows in the financing section. But since we're not doing that, just FYI, and we can kind of ignore that for now. Let's move on to the rest of the question here. They tell us that accounts receivables went from 22,000 to 15,000. Gee, what impact does that have on my cash? That's the question I want you guys to start thinking about as you work through problems like this. Is what impact does that have? So imagine you have a company and you have accounts receivables at the end of the year at 22,000. And at the end of the year, you realized you have $15,000 in accounts receivables. What could have happened? How could your ARs have possibly gone down? How could you have had a decrease in accounts receivables for the year of 7,000? The accounts receivable is money owed to us. So considering the beginning of the year balance 22,000, it seems like somebody paid us. Somebody paid us, and we no longer have the 7,000 in ARs. We only have 15,000 in ARs. So the 7,000 is probably something we received and had a positive impact on our cash account. So that's what we need to do. Anytime we have a decrease in some sort of a current asset, it's typically a good thing because that means either we received money, especially when it comes to accounts receivables, and at that point we need to add it, right? We received some money and thus our accounts receivable balance went down by a factor of 7,000 bucks. That's the impact these balances had on our cash flow. If you had a bunch of receivables and now you have less receivables, we probably got some money that came in. Moving on to inventory. All right, so inventory, another current asset, went from 35,000 to 40,000. We have more inventory now. Generally speaking, what impact would that have on cash? Right? And typically, if you think about purchasing any current asset, it typically absorbs or uses or deducts cash by a factor of 5,000. So I'm going to be subtracting 5,000 bucks. So I'm just going to go ahead and put a minus there to show that I'm subtracting it. This part in yellow is not necessary on your homework assignment. I just wanted to jot it down here so you knew my thought process on how I approach this problem step by step. I start with net income. I take care of some adjustments that I need to net income to free it of any non-cash components. And then I start going down the list of my current assets and current liabilities in the operating section. Generally speaking, in the investing section, you want to look at any long-term assets. And for cash flow from financing, you want to look at long-term debt or long-term liability type of issues, right? So in the operating, net income, as well as current assets and current liabilities. And for investing and financing, long-term assets and long-term liabilities respectively. Coming back to accounts payable. All right. So what happened with accounts payable? Just logically speaking, from the beginning of the year, accounts payable were at 47.5, and now they're at 52,000. What happens when you don't pay your bills? What happens when you don't pay your bills? It's probably not good for your FICO scores, or it's probably not good for your credit. But from a cash point of view, you have more cash now than you would have if you'd paid those bills, those payables. We didn't pay it because our balance increased to 52,000, right? So generally speaking, when you have a liability and it increases, that generally means you had a positive cash impact from it. And so I'm going to add any changes in the accounts payable section that are positive nature as a positive to my cash flow situation. Let's go 52 minus 47.5. And that's a positive cash impact of 4,500. Finally, what happens if there's a decrease in a payable? Decrease in a payable. So at the beginning of the year, our interest payable was $1,200. It is now $400. How do you think we got there? We got there because we probably paid $800 off, right? That's what would have debited interest payable or reduced interest payable. But what impact would that have on cash? That's what you have to focus on a statement of cash flows. So a reduction in a payable means I used up cash. Otherwise, how could it have gone down? So if I used cash, what impact does that have on cash? Broadly speaking, it's a negative impact. So I'm going to put in a minus here. Anytime there's a subtract key over here, I'm going to go ahead and put a minus here. All right. And at this point, all I want to do is just total up all of these things. And because I've already put in negatives, all I have to do is add everything up and it'll take care of the minus items for me. And now we just need to add up these two items to determine the total impact. Oops, that didn't catch the item on top. And it's not allowing me to, so it's all right. I can simply go equal plus this. And there you have it, folks. That's a net cash provided by operating activities. You need to follow this logic forward and consider any investing activities that occurred and or any financing activities that occurred. Once you've done that and you've provided a subtotal for each activity, each of those three activities, you need to net them together. Whether it's a positive or negative, you need to net them together. And when you do, you'll arrive at net increase or net decrease in cash throughout the year. You'll add cash at the beginning of the year, and you should be able to tie into cash at the end of the year if everything is done correctly. I've written copious notes on the actual assignment template for you. There is something funky going on with investing activities. I've explained that in notes as well. It has to do with recognizing some sort of a gain pertaining to it, which exists in net income. So if that's a scenario, I don't recall the problem exactly. I know it's 5-40, but in that problem, if there is something pertaining to a gain or a loss, you'll need to subtract the gains in this section. That's right, subtract the gains or add the losses, because we want a free net income of the previously deducted loss and previously added gain to free this item of any losses and gains, because we're going to account for all of those down here. That's just the one bit you need to know about 5-40. But that problem itself, if you go to this template, you'll actually see the notes that I've written to it that explain it a little bit more. But the idea is always the same. What impact do these things have on our cash in looking at it broadly, right? You're looking at it in a generalized way. I think this will set you up to start off on really good standings. So give it a shot. Give problem 5-40 a start. Re-review this problem and this video I'm going to post for you soon. And I think it'll help you get started with this problem. Of course, always read out the chapter before you begin these types of problems, because there's a lot of new things that this chapter will talk about. And of course, if you get stuck somewhere, reach out to me. Thank you again.